Ever wonder why getting rich isn't just about crunching numbers on a giant spreadsheet? Well, welcome to today's Explainer. We're diving into a fascinating analysis of the psychology of money. If you've ever felt like building wealth is some impossible math equation you just can't solve, you're in exactly the right place. Today, we're looking at why psychology absolutely beats pure math when it comes to financial success. And to kick things off, let's jump right into a pretty mind-blowing story about two very different guys. On one side, we have Ronald Read. He was a humble janitor, spent most of his life sweeping floors and fixing cars at a local gas station. Just lived a very quiet, totally normal life. Now on the other side, we have Richard Fiscone, a Harvard-educated executive and the vice chairman of a massive multinational financial firm. I mean, by all conventional logic and certainly by the sheer math of their paychecks, Fiscone should be the one retiring with an absolute empire, right? But here is the wild part. When Ronald Read passed away in 2014, he left behind a staggering fortune. $8 million. $8 million. Meanwhile, our brilliant Harvard executive, he lost literally everything and went completely bankrupt during the 2008 financial crash. All his massive multi-million-dollar earnings were just entirely wiped out. So how on earth does a gas station worker totally crush a financial whiz? Well, it's because making money isn't actually mathematics, it's psychology. Ronald Read definitely wasn't a math prodigy, but he absolutely mastered his own behavior. Your financial success is primarily driven by your mind, your emotions, and how you react to the world. All right, Section 1, the hidden forces of luck and risk. Before getting into any hardcore strategy, we have to talk about the invisible stuff that shapes our financial lives. Take Bill Gates. We all know he worked incredibly hard, but as the source material points out, he was also exceptionally lucky. Back in 1968, nobody had a computer, but the specific high school Gates attended just happened to have one. Now compare that to his childhood best friend, Kent Evans. Kent was arguably even smarter than Bill, but he tragically died in a mountaineering accident before he could even start his career. He experienced the ultimate extreme risk. It's a sobering reminder that we don't control every variable, which is exactly why our psychological approach to the variables we can control is so absolutely crucial. Moving on to Section 2, the magic of compounding. If pure intellect isn't the key, and we obviously can't control luck, what is the ultimate secret weapon of the wealthy? Well, check this out. See that tiny 5% slice? That represents all the money Warren Buffett made before he turned 65. That massive 95% chunk, that is the wealth he accumulated after his 65th birthday. The math of compounding is easy enough for a child to understand, but letting it work uninterrupted over decades, that requires immense psychological endurance. This is exactly what Ronald Read nailed. He quietly held his investments for 42 long years. He didn't flinch. Most beginners, they totally panic and stop investing at the very first sign of market volatility. They let temporary fear completely override the long-term math. Warren Buffett's real superpower isn't some magical stock-picking formula. It's his psychological patience. Leaving your money alone for decades, watching markets crash and recover, and just doing nothing, that is a massive psychological triumph. Okay, Section 3, getting wealthy versus staying wealthy. Because accumulating the money is really only half the battle, keeping it requires a completely different mindset. There's this huge psychological flip you have to make. Getting wealthy demands risk-taking, relentless optimism, and putting yourself out there. But staying wealthy requires almost the exact opposite. You need frugality, building a margin of safety, and honestly, a healthy dose of fear that what you built could just disappear. And let me tell you, that mental pivot is incredibly difficult for highly successful people to pull off. Just look at Jesse Livermore, historically known as the greatest trader ever. In the infamous 1929 stock market crash, while everyone else was losing their shirts, his math and market timing were so dead on, he made $100 million. But his psychology ultimately failed him. He couldn't shift gears from getting to staying wealthy. He just kept taking massive risks, and 4 short years later, he was entirely bankrupt and tragically ended his own life. Here's the good news, though. You don't even have to be a math genius who's right 100% of the time. Take Hans, the legendary art collector. He bought 99% terrible art, but was saved by picking just one Picasso. Even Warren Buffett made 99% of his returns from just 10 out of the 400 to 500 stocks he bought over his lifetime. We call these tail events, rare hits that drive the vast majority of outcomes. It means mathematically, you can literally be wrong half the time and still win big. But psychologically, you have to survive all those losses without giving up or losing your mind. Which brings us to Section 4, the traps of ego and envy. If the math gives us so much wiggle room to be wrong, what actually destroys the wealth of highly intelligent people like our Harvard executive? It boils down to the deadly trap of ego, summarized brilliantly by the man in the car paradox. Think about it. When a sleek Ferrari drives by, you don't look at the driver and think, wow, that driver is amazing. You look at the car and imagine yourself driving it. Yet the person buying the Ferrari mistakenly believes everyone is admiring them. People literally gamble away their financial security just to impress total strangers who are only daydreaming about themselves anyway. This unchecked greed and envy is just toxic. Take Rajat Gupta. This guy was a McKinsey CEO, partnered with Bill Gates, with a net worth of $100 million. Mathematically, 100 mil is enough to fund your family for generations. But psychologically, it wasn't enough for him. Driven entirely by ego, he desperately wanted to be a billionaire, engaged in illegal insider trading, and ended up in a jail cell. His pure intelligence built a massive fortune, but his total lack of psychological control burned it to the ground.
So, Section 5, the equation of wealth. To dodge these catastrophic traps, we need to completely redefine what wealth actually looks like.
True wealth is invisible. It's the financial assets that haven't been converted into flashy, visible stuff. Remember Richard Fusone and his 11-bathroom mansion? That is highly visible wealth, and it eventually bankrupted him. Invisible wealth is the money you don't spend. It's the funds sitting quietly in an account, buying you the ultimate luxury, absolute freedom and peace of mind. And this gives us the absolute golden rule. Wealth equals your income minus your ego. Sounds super simple, right? But it represents literally the hardest psychological test in the world. Ronald Reed, our janitor, had a tiny income but zero ego, resulting in massive wealth. Fusone and Gupta had sky-high incomes, but their egos were even bigger, and the result was absolute ruin. If you let your ego inflate your lifestyle, you get trapped. It's like folks who sell off prime real estate to buy a huge luxury SUV, only to suddenly realize they can't even afford the gas to drive it. You have to flip your perspective. When you invest, view market drops not as a fine for doing something wrong, but simply as a fee you pay for long-term growth. Because life is totally unpredictable. Nobody mathematically calculated the exact timing of the 2008 crash, right? You always need a margin of safety, a financial buffer, so when life throws a wrench in your plans, you actually survive the unexpected. So as we wrap up this explainer and think back to how a humble janitor completely outsmarted a Harvard executive, you have to ask yourself a pretty profound question. Are you playing the long game to secure true and visible freedom? Or are you just risking it all to look wealthy in a Ferrari? Remember, building wealth is not a math test. It's a mirror reflecting your psychology. Thanks so much for joining me on this explainer today, and I really hope this transforms how you think about your own financial journey. Catch you next time.